Let's go across to Gajendra Kothari, Managing Director and Chief Executive Officer at Etica Wealth Management, to talk about how young investors should be investing right now. Gajendra, good afternoon. Thank you for joining us. Now, Gajendra, we get a lot of questions from some of our young viewers who have just started working. What is the first baby step they should do while planning a portfolio?
So my advice would be that the sooner you start, the better it is for you. And there are three things you should look to start your investment portfolio. The first thing is that what are your goals? And you should divide it into short-term goals and long-term goals. So if you have requirement for short-term goals, start saving and put into safer instruments which can give you the required rate, and you can withdraw the money whenever you require it. Now for your longer-term goals, the goals can be divided into like retirement goals, or you can have a house purchase goals maybe 10 years down the line, or you can have a children's education planning, such kind of things. For these goals, you need to put your money to work, and the best way for long-term investment would be to go through the SIP route, which is systematic investment planning. And if you invest whatever 5,000 or 10,000 rupees per month over a longer term horizon, you can expect around 12 to 14% return, that too tax-free, and it can help you meet all these financial goals for your longer term requirement.
But should all young people buy life insurance as well?
So Faye, I think life insurance is a very important component of financial planning. The first thing a young person should do is identify who are the dependents on him in his family. So it can be his parents who have retired and are depending on his income, or it can be his spouse who is a housewife, and also she is also dependent on his income. So if he has dependents, he should go for a term insurance cover, and the ideal amount is a thumb rule which says 10 times of his annual income. So if his annual income is presently 5 lakh rupees, he should at least have a 50 lakh rupees term insurance cover. He shouldn't go for any other insurance cover for his life insurance requirement.
Now, most young people have a PF deduction. Should they also invest in, let's say, PPF or FDs?
So Faye, I think that would depend on what kind of investor he is. If he's a very safe investor, doesn't want to take any kind of risk, and is looking for guaranteed returns, then I think PPF is the best form of investment. Presently, you are getting 8.7% interest per annum, and the money is logged in for 15 years. So this is the safest and the best form of investment. I wouldn't recommend FD as alternative, because there it is taxable. But if somebody can spend, and if somebody is a young person and he has 15 years to look forward, then in my opinion, I think equity funds are the best way to save for long term. They give you tax benefits also, and over a longer term horizon, you can expect around 13 to 14% return, which is very much possible. I mean, this return is very much possible to beat inflation, and you will see net positive returns from your portfolio.
Gajendra, good chatting with you. Really appreciate you taking the time out and speaking with us.